Let me start with the stock performance first. Reliance Industries has had a great run up until now. In fact, the stock is sitting at a 52-week high and is up almost 30% from the lows that we saw in the month of March. But let me run you through the basic numbers and then I'll talk about the key businesses. It's expected to be a slightly muted quarter this time around for Reliance Industries. On the top line, we're expecting a marginal growth to about 2.18 lakh crores compared to 2.13 lakh crores last quarter. The pressure will seep into the operational front. So look at this, a 0.5% lower EBITDA is what we're looking at. The margins could come under a bit of pressure as well. And on the profitability front, we're expecting a 14% fall compared to what they've seen last quarter. So where does the pressure lie? Now, it's expected to be a mixed bag this time. While the refining segment has been under pressure globally and for Reliance Industries, the consumer businesses continue to be very steady. So let's talk about the refining business first. There is a dip in the refining margins this time around. In fact, Singapore gross refining margins have come in at $4 a barrel, which is a fall of 51% quarter on quarter because of the decline that we've seen in the cracks. Apart from that, if you look at the refining business, the dip in this segment will more than offset the higher petchem margins. And overall, in Q1, the gross refining margins for Reliance Industries are expected to fall 31% quarter on quarter. But let's move to the consumer businesses, which have been very steady, both Jio as well as retail. On Jio, the subscriber additions will be a healthy 25% higher than what we saw last quarter, coming in at 8 million subscribers. And even if you look at, the core business, there's a 15% year-on-year EBITDA growth that we're looking at, while the margins will be steady at 52.4%. Even the retail business has grown very well. So there's a 20% revenue growth, a 32% EBITDA growth in the retail business. That's largely because of an increased store footprint and better operating leverage. Now, there are a couple of things that the street will look forward to in the numbers this time. One of them is any developments on the new energy business. In fact, Goldman Sachs put out a report where they are valuing the new energy business at a base case at $29 billion. So any update on that will excite the street. Apart from that, all eyes will be on the AGM and details of the Jio Financial demerger.
So for Reliance Jio, the telecom business of Reliance Industries, we're anticipating a 3.1% top-line growth on a quarter-on-quarter basis. This 3.1% revenue growth will be driven by a 1.8% increase in the company's subscriber and a 1.3% jump in the average revenue per user, which is called ARPU. Now let's talk about the subscriber growth. Now TREI gives you a monthly subscriber number. The last number that we have is for the month of April, where Jio added 3 million subscribers. If you extrapolate that for the full month, analysts are working with a subscriber addition of about 7 to 8 million subscribers, which turns out to be a 1.8% growth. Now let's move on to ARPUs. ARPUs this quarter are expected to continue to inch up, 1.3% growth, 181 rupees is what the street is anticipating. Revenues in ARPUs are also likely to benefit from one extra working day in the current quarter. But ARPUs for the company have been on the flatter side for the last 2 quarters. Moving on to margins, margins is seen with a positive bias. 52.5% is the CNBC TV18 poll, and the profit number is approximately 4,800 crore rupees. There are 2 key things the street will track. 1, the timing of a broad-based tariff hike. And 2, if you remember, the company did a launch of a 4G phone, a smartphone, Jio Bharat. So the kind of expectations from the uptick in the number of phones sold, that's going to be something that the street is tracked and whether it's gaining traction.
What should one expect for Reliance's retail business? Well, more of the same, but a little more improvement. Because quarter on quarter, there has been gradual recovery in consumer sentiment, and the company's own store footprint expansion along with operating leverage would mean that the EBITDA grows a tad higher than the revenues itself. What is the street working with in terms of revenues? 1.6% growth, a little over 70,400 crores. That's what analysts at Kotak expect for Reliance's retail business this time around. The EBITDA actually goes above that 5,000 crore mark. We're looking at a growth of about 3% quarter on quarter, and that would mean margins not only maintained but improved by about 10 basis points quarter on quarter as well. But remember, same time last year, from now, there has been a strong expansion in store footprint and improvement in consumer sentiment as well. So 20% year-on-year growth led by 32% jump in EBITDA is something that the street is anticipating. But it's not just this quarter that we're looking at. The company is on a growth path, so the performance of newly acquired brands and new launches, the new formats that they've launched, would be extremely crucial to watch out for. And also keep an eye out on some more announcements coming in with regards to some more acquisitions or store expansion plan as well. All of this eventually leading to value unlocking in their retail business at some point in the near future.
Well, the O2C segment of Reliance Industries this time is expected to be mixed, largely because while refining will see a decline, petrochemicals will continue to see some growth. Starting with what the Singapore GRMs looked like this time, it was a 51% decline on a quarter-on-quarter basis at $4 per barrel, and it is largely because of decline in cracks across product profiles. Something like gasoline saw a decline of 17% in terms of cracks. LPG, naphtha and middle distillate cracks also declined during the quarter because of lower demand coming in. Refining throughput also for the company is expected to be flat on a YOY basis. However, it will be up 2% on a sequential basis, so volume-wise the company will do well. Now, Kotak has put out some estimates as far as their EBITDA is concerned. It is expected to decline 25% on a YOY basis, 8% on a sequential basis to come in at 14,972 crore rupees, largely led by the refining segment, something that the entire industry is witnessing as well. That's about O2C, but about the oil and gas business, which has been firing on all cylinders, will continue to do well yet again. A 10% increase in volumes this time on a YOY basis and a 7% increase on a sequential basis is expected to 22.1 MMSCMD. Gas prices also will be higher on a sequential basis. They will be higher by 10% on a YOY basis at a premium here at $11.2 per MMBTU. What will this mean? That means the EBITDA will increase by 45% on a YOY basis and 4% on a sequential basis. It will continue to do well. So that's what we are expecting from the oil and gas business this time.